Would you like to invest in a business model that's been virtually unaffected by the pandemic? Want to sleep well at night knowing that you're invested in something people can't live without? Want to collect market-smashing passive dividend income with a yield more than twice as high as the market? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out, grow the channel, and I'd really appreciate it. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing critical and necessary electricity to captive customers. Try living without electricity for a whole day. You basically can't do it. That's how necessary this service is to our modern day society. And this stock profits from that innate need. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Portland General Electric Company, which appear to be trading at a significant discount today. Portland General Electric Company, stock ticker POR, is a regulated electric utility that serves approximately 900,000 customers across the state of Oregon. Founded in 1889, the company is a $3.7 billion by market cap vertically integrated utility that's engaged in generating, purchasing, transmitting, distributing, and retail selling electricity. Fiscal year 2019 retail revenue breaks down across the following customer classes: 52% residential, 35% commercial, and 12% industrial. Their generation mix is 33% natural gas, 30% purchase power, 14% hydro, 14% coal, and 9% wind. This generation mix, however, is set to become cleaner with the development of the WHEATRIDGE Renewable Energy Facility. This will be the nation's first major renewable energy facility to integrate wind and solar generation with battery storage in one location. Portland General Electric has partnered with the venerable NextEra Energy Inc. on this facility. The utility industry entered the health crisis in a great position. After all, electricity is a basic need that modern society cannot live without. We've seen that position of strength play out over the last few months. The pandemic hasn't really affected utilities. There's been a shift in terms of where usage occurs, and industrial activity is certainly down, but the core business model is as necessary and strong as it's ever been. That's great news for investors, and it's also great news for dividends in this space. As it sits, Portland General Electric has increased its dividend for 15 consecutive years. In fact, they just increased their dividend at the end of July by almost 6%. If that's not a sign of strength, I don't know what is. The 10-year dividend growth rate is 4.1%, and there's been a mild acceleration of late. The 5-year dividend growth rate is 6.1%. That vigorous growth comes on top of the stock's starting yield of 4.4%. This yield, by the way, is 140 basis points higher than the stock's own 5-year average yield. And with a payout ratio of 62% based on trailing 12 months earnings per share, the dividend is easily covered and within management's targeted payout ratio range of 60% to 70%. Looking at business growth, the company grew its revenue from $1.783 billion in fiscal year 2010 to $2.051 billion in fiscal year 2019. That's a compound annual growth rate of 1.57%. It's not an excellent result, but this isn't out of line with what I commonly see across the broader utility space. Meanwhile, earnings per share advanced from $1.66 to $2.39 over this period, which is a compound annual growth rate of 4.13%. That lines up very well with the 10-year dividend growth rate. Notably, this is on the low end of management's own future guidance. Management is calling for 4% to 6% long-term diluted earnings per share growth. There's been a nice expansion in margins over the last decade, which has helped to propel that excess bottom line growth. Looking forward, CFRA is projecting that Portland General Electric will compound its earnings per share at an annual rate of 4% over the next 3 years. This isn't exactly a stretch, it's basically an assumption that the status quo will continue. I would look at this 4% earnings per share growth rate projection projection as the low end of what the company is capable of moving forward. And that also translates over to the dividend growth. Meeting in the middle would be 5%, and I think that's a perfectly rational expectation. For comparison, Morningstar states, and I quote, PGE can grow the dividend 6% annually in line with peers given the growing economy in its service territory, investment opportunities, and cash flow to support up to a 70% payout ratio, unquote. One ugly wart on an otherwise attractive utility business is the very recent disclosure of rogue energy trades in the wholesale electricity markets, leading to a $100+ million loss for the business. 2 employees are on an administrative leave. The news also clobbered the stock, down as much as 14% on August 25th. That clobbering is why I'm talking about this stock, and it's also why I'm so enthusiastic about its prospects at this time. If you buy a stock when it's all roses and sunshine, you pay a high price. Indeed, I've long seen this as an overvalued utility, and I never publicly featured it before. But the valuation has finally come down to a reasonable level, and here we are, now talking about it. This stock was $63 back in February. It's now well below $40. You choose which price you'd rather pay. While the rogue trading news is unfortunate, it's a one-time event that doesn't change the long-term story. Morningstar lowered its fair value on the stock by $1 after the news came out, which I think is appropriate. Portland General Electric has approximately 90 million shares outstanding. A $1 cut in value per share roughly corresponds with the size of the loss. CFRA, on the other hand, lopped $12 off of its 12-month target price, which I see as a gross overreaction. Guggenheim analyst Shahrir Pereza had this to say about the news after maintaining their price target, and I quote, "While the announcement is an unpleasant surprise, the loss is containerized to the third quarter, with the company currently reaffirming its long-term 4% to 6% earnings per share growth rate, maintaining its dividend plans, and already holding discussions with the rating agencies." Portland General Electric had a strong liquidity position coming off of COVID in the second quarter and plans to issue some additional long-term debt to cushion the impact. "We see this as an unfortunate one-off event," unquote. I strongly agree with the Guggenheim note. Moving over to the balance sheet, the company has a solid financial position that's in line with what I'd expect for a utility. The long-term debt-to-equity ratio is 1.0, while the interest coverage ratio is near 3. Profitability is fairly robust, with the company sporting numbers that are competitive with much larger utilities. Over the last 5 years, the firm has averaged annual net margin of 10.07% and annual return on equity of 8.30%. The business model has been virtually unaffected by the pandemic. The rogue trading, while unfortunate, didn't have anything to do with the pandemic or otherwise indicate a problem with core operations. If anything, the dramatic pullback in the stock has moved this stock from mildly undervalued to one of the more compelling opportunities in the entire utility space, in my opinion. The company's geographic monopoly, regulatory framework, and scale are mighty competitive advantages protecting the future of the business. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Regulation is a key risk that's particular to all utilities. Local governments heavily regulate utilities and cap their growth. In exchange, utilities are allowed to run local monopolies that have built-in profit, which scales up with operational costs. The recent trading issue shows a clear need for better internal controls and governance. This utility isn't as geographically diversified as some larger utilities, and Portland General Electric's fortunes will largely rise and fall with the fortunes of the greater Portland, Oregon area. There's also political risk here, due in large part to the service area. The Portland area will likely be more aggressive than average in terms of pushing cleaner energy initiatives. Overall, I now see this as one of the most appealing utility stocks out there. The 40% drop from its 52-week high has created an amazing opportunity in terms of the valuation. The stock is trading hands for a price-to-earnings ratio of 14.1. That's well off of the stock's own 5-year average price-to-earnings ratio of 20.2, and it's also well below the broader market. Then there's cash flow. The price-to-cash flow ratio at 5.7 is materially lower than the stock's 3-year average price-to-cash flow ratio of 7.2, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis, factored in a 9% discount rate to account for the high yield, and a long-term dividend growth rate of 5%. This dividend growth rate is basically splitting the difference between the company's own short-term and long-term dividend growth rate. It's also splitting the difference between management's future earnings per share growth guidance and what CFRA is projecting for over the near term. I think the company is perfectly capable of doing better than this, as evidenced by recent dividend increases and Morningstar's forecast. But the recent trading issue will curtail near-term growth, and I'd rather err on the side of caution here. The dividend discount model analysis gives me a fair value of $42.79. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stock. Morningstar rates POR as a 4-star stock with a fair value estimate of $43. CFRA rates POR as a 3-star hold with a 12-month target price of $38. I came out almost exactly where Morningstar is at, which I think is accurate. Averaging the 3 numbers out gives us a final valuation of $41.26, which would indicate the stock is possibly 11% undervalued. Here's the bottom line, guys. Portland General Electric Company is a high-quality utility providing a necessary service to society. Operations have been virtually unaffected by the pandemic, yet the stock is cratered and presented a rare glimpse of undervaluation. With a yield more than twice as high as the broader market, 15 consecutive years of dividend raises, a moderate payout ratio, and the potential that shares are 11% undervalued, dividend growth investors looking for a cheap, quality utility would be wise to consider this stock right now.
Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.